Good afternoon, good morning, good evening, depending on your time zone and when you watch. I want to thank you for coming to our panel discussion titled The 2022 Biopharma Capital Outlook, Strategies to Navigate a Shifting Financing and Strategic Marketplace. It's a mouthful. On the heels of the publication of Locust Walk's year-end market conditions report, we are joined by a great panel of experts to help us unpack the trends in the industry as 2021 ended. We have 1 hour allotted for the panel, including questions that we've prepared in advance, as well as questions received in advance from participants. If you have any questions you would like the panelists to address, please submit them through the Q&A system, and I'll read out the most frequently asked questions and ones that have the broadest applicability to the audience at the end. As a reminder, there is a market conditions report, which should have been in the invite, so if you want to download that, you're welcome to do so for some of the trends. If we don't have time to address your question, we'll follow up separately with our thoughts. We are recording the session and the playback will be available shortly thereafterwards for all attendees. I'm also obliged to share that due to confidentiality obligations and other regulatory requirements, we will not address questions specific to any one company, of course, unless Liz and Eric want to talk about their companies, and that's to their prerogative. This is not considered legal advice or an offer to buy or sell any security. Everything discussed is considered off the record. So, summary of where we are. 2021 was a tale of two cities, the best of times and the worst of times. Public financings reached a record volume of deals, while biotech indices underperformed epically. The amount raised per deal lagged from 2020. Biopharma experienced a record number and value of private financings over 21, while the volume of licensing transactions remained relatively constant at a high volume and value compared to 2020. M&A picked up towards the end of the year with the buy-side bid coming back. We'll hopefully hear more about that, but still below the 2020 and 2019 levels on total value and average deal size. What do all these changes mean for the industry's 2022 prospects? After the panel we did last November called Has Biotech Peaked?, we've seen both positive signs for 2022, but also potential hangovers from 2021's continued market sluggishness through today in January. How should biotech executives navigate these turbulent waters on the capital formation, capital raise, and strategic transaction fronts? Will the water smooth out, or will the storm clouds grow in 2022? So with that said, I wanted to introduce the panelists. I'll do that for them so we can get right to the heart of the matter after the intros. So I'll start with Eric. Eric Heil is a venture capitalist and former serial CEO and entrepreneur. In early 2020, he joined Medical Excellence Capital as managing partner, and they are an early stage life science venture fund that has a unique model where they have a proprietary medical network of leading physicians and academic medical centers that they draw on for deal flow, diligence, et cetera. He's co-founded several startups that were successfully sold and was also an investment professional in EIR at Domain Associates, a leading venture fund that had more than $2.5 billion under management. During his tenure there, he worked in Corthera and Celator in business development, both of which were bought by Big Pharma. So welcome, Eric. Liz Levier is also joining the panel. She brings lots of experience at large pharma companies in business development. She's currently head of the Merck Boston Biotech Innovation Hub. Its business development and licensing team focuses on early stage therapeutics, pre-proof of concept, as well as accessing research and technologies through collaboration, license, M&A from academic, pharma, and biotech. Before Merck, she was at Novartis in the NIBR in strategic alliances, where she led multiple transactions, co-stim, partnering deals with Servier, PeptiDream, and several others. She has also industry experience in scientific roles at firms like Aveo, Axeli, and Genzyme. So welcome, Liz. Thank you for joining. Brian Coleman, next on the list, joined Locust Walk as Global Head of Capital Markets in 2018. So he's responsible for doing all of our financing deal making at the firm on a global basis. Brian has spent an extensive career, an impressive career, raising money for lots of different companies. He's raised over 700 rounds of financing, having most recently served as global head of equity sales at Jefferies for 10 years, and also was in senior roles at Bank of America, JP Morgan, Lehman Brothers, where he managed more than 80 different people, called on 2,000 investors, so has a wealth of experience he can share with us. So welcome, Brian. Last and certainly not least, we have Andy. who brings tremendous experience to the panel on the strategic side, on the legal side, but also on the capital raising side. He joined Locust Walk in 2014. He's the global head of strategic transactions, mostly working on buy side and sell side transactions. Before that, he was an associate at Gunderson Detmer, a life science law firm focused on growth companies. He worked on all different areas of securities law, private placements, public offerings, mergers and acquisitions, et cetera. He also worked at Wilkie Farr and also as a banker at Credit Suisse. So welcome, Andy. Now that I've powered through all that, I think let's get to the heart of the matter. What I'm going to do is, since we have 4 different perspectives, I'm going to try to assign people based upon their experience set, but obviously want to let everyone have a chance to answer questions that they find relevant or helpful. So Eric's going to cover the early stage venture and venture creation. Brian's going to cover crossover IPO public markets. Liz is going to focus a little more on the buy side, given her perch over at Merck. And Andy, while he can cover lots of bases, is going to predominantly focus on the sell side for the small companies who want to do a deal with Liz. So that's the frame, and let's dive in. So it's been no secret that the biotech public markets got hammered in 2021. Major indices finished the year in the red, big divergence from the S&P 500, which I think the XBI was down, roughly 20%, and the S&P was up roughly 30. So a massive underperformance. And IPO activity, actually, it tried to maintain pace with 2020, but the second half saw the aggregate value and the deal size really start to decline. So I'm going to start this one with Brian, because I know there's a lot of questions coming in from the audience before the panel started. What do we think this activity is driven by? What's the major driver behind the slowdown and the underperformance?
Thanks, Jeff. I think it's a combination of things. Obviously, the index in the broader market as it relates to biotech was negatively impacted in this past year. But if we looked kind of 2 years prior, it had a really good run, which brought in a lot of generalist money into the space. It ultimately drove up valuations. I think from an IPO standpoint, there were 70 IPOs in 2020, 70 plus, and 90 plus last year. So I think to me, it's a correction, not necessarily a bubble. We've seen significant cash flows into the space, and ultimately there's plenty of dry powder on the sidelines to do deals. I think what we'll see is people being a lot more discerning on valuation, a lot more diligence looking at the science, and likely to see later stage investing as opposed to earlier stage companies, kind of preclinical companies.
So then just a quick follow-up on that, Brian. So you're thinking that the more proven companies will be the ones that will successfully get public, but it's not necessarily a closing of the window in your view?
Yeah, I mean, I think later stage multi-asset companies are probably going to be a preference as you kind of think and consider the risk profile. As we've seen in historical kind of trends, when money starts to flow into biotech, there's a tendency to go earlier stage preclinical. So I think there'll be some reversion back to the mean over the course of the year.
So an actual Series B, not the Series B crossover.
Yes.
Already starting to hear that. So Liz, I'm gonna shift over to you just to get the strategic side of things. There's been, I'll call it, a lack of M&A activity, even with a slight uptick towards the end of last year and the beginning of this year. Do you think that that's indicative of anything? Do you think that means that there's going to be a shopping spree, or how do you think about the changing of the M&A landscape for the biotech world?
So thanks, Jeff, for that. I think given the recent past, right before the recent year or two, we did see many folks not need to partner, right? That they had plenty of dollars out there to do the work and get to the next inflection point. And now we're seeing the potential kind of back to M&A openness for us as well as deals. I think from the Merck perspective, nothing's changed. We will do acquisitions where it makes sense scientifically. We really are following the science. And so assuming the biotech field, continues on the path of investing in the right opportunities, the right assets, that's when, we'll be activating our M&A activities. It has to make sense for both us as well as the investors in that particular group. And we're not. I think we're not really interested in the the large mergers that that I don't think that's going to occur. But in general, where the acquisitions are right to bring in assets that will make a difference to patients and really be differentiating, we are open for business.
Cool. So I'll get to Andy in a second to follow up on this, but maybe just a quick follow up. So how do you think about a license versus acquisition? Because we did see licensing volumes holding relatively steady. We'll talk about the implications on the financing side for doing a license versus raising capital. But if M&A hasn't been as in vogue, and you're saying it's still business as usual, how do you make that differentiator between we're going to buy you or let's just rent you and see what happens?
Yeah, and remember, like a lot of the work that myself and my team does is that pre-proof of concept. So before in humans that the assets are actually working. And so in that world, it really is dependent on the external party's needs. Of course, it's what we need as far as what assets make sense to bring into Merck and be able to bring them to patients. But it also is when we talk to the external party, what do they need from an investor point of view? Are they at the point where they have assets that they'd rather license and keep the rest? It's a dilution of equity and when you're thinking about some deal or a dilution of assets, right? And so it really is that looking at the company as a whole and saying what makes the most sense for what we're interested in and bringing forward into our therapies to patients versus the total value of the company. And if the investors are saying we'd rather have an exit, we're trying to decide whether to do a crossover round and go IPO or do some type of deal, a licensing deal is not attractive to us. It's acquisition. So it's really those discussions with external parties to know where are they in that kind of decision point as far as raising financing, what the next steps are up to the next inflection point of what makes the most sense, and then does it work for us?
Yeah, so that's a great segue because we're going to cover on how do you think about early stage licensing versus financing, and because we have not seen too many pharmas buy companies at a very early stage of development, which is why there hasn't been the usual dual track IPO versus sell, because it's just earlier stage assets. So that's interesting perspective. So maybe Andy, if I could throw it over to you, just thinking about the licensing view on interest level this year from what you're seeing, talking to companies around using licensing as a tool in light of the markets that we're in.
Yeah, absolutely. I mean, I think Liz raised a number of really good points, especially in terms of how a company such as Merck has to approach the situation. And from the sell side, it's really being able to understand, well, what is it really that you're trying to get accomplished? And coming off an environment where it was relatively easier to get capital versus having to try to find a BD deal, that's what people were doing almost as a default. And now we're going into a little more complicated environment on the capital raising side. Suddenly you have to start making some decisions in terms of where do you want to prioritize your spend as a company? Where is it that you want to be focused as a company, especially if you have a broad pipeline? And Liz raised a point about asset dilution versus equity dilution. Either way, it's dilution. It's just sort of what's your purpose? And what are you trying to do? If you're trying to out-license something as a financing mechanism because you can't raise the capital, okay, but then also having to think through things in terms of, whatever it is we're about to go through or are going through is not going to stay that way forever. And so when things do turn around, what do you look like on the other end of it? And so I think that really what we're going to see is even on the licensing deals that were done, a lot of them were the quote unquote validation deal that was to unlock the crossover to let you move forward with those platform deals. We're probably going to see a different structure, a different type of deal start to work its way through is my guess. And I think it's really going to be focusing in on, okay, what is it strategically that makes sense for us now? Why are we doing this deal? To Liz's point, what are we going to do to ensure that when we come out of this on the back end, we still look good as a potential public company or as a public company, if that's the case. So I think we're going to see more creativity, which I think is always good. And we're going to see a number of conversations that are just going to take place very differently between buyers and sellers.
So Eric, as an investor in early companies, and this is kind of a hot topic, maybe into and of itself, how do you advise your portfolio companies to think about licensing versus capital raising? And then we can dive a little deeper into the fact that, and I'll just tease it, that historically in the last couple of years, most firms of creating companies have shied away from partnering in a large part because they wanted to preserve the whole company when it goes public. And so is anything changing in that regard, or how are you thinking about your portfolio companies with licensing as an alternate way of creating value?
It's a great question. I love Andy and Liz comments on this earlier too, between the asset and the equity kind of calculus to it. But at the end of the day, it's the business model that these companies are trying to pursue. So there's been a lot of capital flowing into platform-based companies where investors are actually inviting more partnership opportunities because you can't boil the ocean in every various therapeutic areas to validate the technology across the board. So as investors, where can we partner with a pharma in a therapeutic area that is maybe not of interest or too capital intensive for us to pursue on our own to help get that validation? And then what's a second or third program where we can then carry it forward in a way that we are able to retain a lot of that value in-house as an organization. And I think it's going to be that playing out over time that's going to then flip the conversation to more of a continued licensing opportunities to an MAA, because you got the relationship in one therapeutic area and now you got in-house assets carrying forward. So just trying to think through both the technology, the business model, and then who the right partners are for the therapeutic areas and what can we do kind of carrying them forward. To Brian's point around, there's a lot of capital or generalist capital that had flown into the public markets. I just think there's a natural rationalization of, capital that's happening right now. And all the IPOs that were referenced, it takes a while for the specialists to kind of sift through all that. Where are the milestones? Where are the investable opportunities? Where are the unmet needs? But fundamentally for us and the company creation early stage, it's the fundamentals of biology and the science are better than ever, so let's just focus on the science, the unmet need, and then trying to match the capital and the partner model, to support that.
So just to summarize, that's a much more open or willingness to consider early partnering as validation, incremental capital, as a way of trying to improve the return profile for the company. Is that fair?
Yeah, it's well said. No, that's exactly right.
Cool.
Yeah. And Jeff, just to piggyback on that, what Eric just said, JP Morgan was 2 weeks ago. And I would say my biggest kind of overarching view after meeting with multiple groups was more of an openness at this JP Morgan for that early partnering. I definitely heard that, as opposed to previous years where we'd hear more of there's plenty of capital, we can do it ourselves. Unless it's a transformative deal, we're good. Whereas this year there was much more of, there's too much to do. So we need, it would be great to have a partner to help. So it definitely is coming through in those discussions.
So Liz, I know the answer because we did this on the prep call, but maybe you can elaborate a little more about the types of companies that are saying that, because I think it's interesting that it's not just one group, but there's, I don't want to give away your answer.
Yeah, I mean, the types, most of my JP Morgan a couple of weeks ago was with venture capital. My team typically meets with the biotech companies that are in their portfolios. And so it's a lot coming from the investors that they see the value now in potentially partnering with a group like Merck because of the potential of maybe getting to a therapeutic faster, proving the platform faster, especially with platform companies, right? Proving the platform potentially faster. And there's still room for the company to have value because they have their platform, they can develop their own assets at the same time. So I think it's shifted from a recognition that, partnership wasn't needed to, maybe it would be helpful for the future.
And as far as company types, does it go beyond just venture-backed companies? Has there been any shift in that realm?
I think that, there's from the smaller biotech that are, really early raised, money on a shoestring, that's never changed. They've always been very eager to partner. So I think it is mostly the, the VC backed, private groups.
Andy, have you seen any change on the public side? And then I'll circle back around to Brian.
Yeah, I mean, I think that what Liz is saying has certainly extended to public companies as well, especially a lot of the companies that have gone public in the last 3 or so years. They raise a good amount of money, but they're now reaching the point that they're going to have to raise more money, and they're seeing what just happened to their equity prices. And so it's not a great environment for them to take that level of equity dilution. And so I know from my conversations, there's a pretty consistent message that people want to think through what else is going to be available to me. Is it through regional deals? Is it through co-pro co-devs? What assets should we make available, et cetera? And how do we initiate those discussions? And so I think we're going to see it up and down the biotech side of people being much more active on the BD front. And that's also true on the buy side within biotech. There's a number of biotechs that raised a lot of money and they have more than what they need in order to, get through whatever period we're in right now. And so they're going to think through how can they be creative in how they deploy it to bolster a pipeline so they look stronger on the other side too.
Yeah, unless you think we're just trying to argue for more deals, we've definitely seen public companies who don't really love their stock price right now, who are thinking about asset dilution more favorably than equity dilution. And how do you not sell the company without selling the company to retain enough, but still how to use that as a lever to help finance the company?
Sorry, we just had a recent conversation in one of our portfolio companies just around the universe of potential financiers out there. So you have pharma on the kind of the asset partner, even as equity investors too. We've done that. But whether it's family offices or even tech investors looking at this convergence of tech and therapeutics, there's just multiple, new sources of pools of capital where some of our connections, relationship networks are only in segments of that. And so I think trying to think more broadly through relationships and partners, advisors, on how to tap into that earlier on for these companies, we're spending a lot of time thinking about.
And we're also, Jeff, as you know, we've also seen kind of the convergence of companies looking to raise capital and potentially putting in place a dual track or a triple track process to essentially look for a partner and or a strategic as part of the process. And there's been a number of cases, and we're working with one company right now that ultimately we went out with a financing, and it's ultimately going to pivot to a strategic deal. And it was an investor who ultimately stepped to the plate and said, this is worth doing. This is good value at this point. So I think to Eric's point, there's no shortage of capital. It's a question of how they want to allocate it and in what structure. And I think it'll be interesting the next 6 months. The companies that we've had discussions with over the last 2 to 3 months, most of them want to entertain more than just a traditional financing.
So Brian, maybe just to piggyback on that, to get some of the impact of the public markets on the private markets, and the fact that both public biotechs and private biotechs want to do more partnering as a way of getting non-dilutive or less or different dilutive capital. Are you seeing an impact in the private market because of the downdraft on the public side? And what does that look like? Why is that happening, or how does it manifest itself?
Yeah, I think, as I said earlier, when biotech is on a good run, you get capital coming in from a lot of different sources. I think the generalists have a tendency to follow the alpha. And so to Eric's point, we're living through, in my mind right now, kind of a two-step process. One is the public investors trying to determine what to do with their public holdings. And the other is kind of the question of where along the line do I want to invest on the private side? Do I want to go earlier stage and give it a couple of years ahead of needing to go to the public markets? Or do I want to be later stage, and what sort of criteria is needed in order to get there? Platform company, more information, more milestones, news flow, et cetera. So it's if anything, I think investors are going to look for greater value. They're going to look for more supporting data behind the programs. And likely, take time to make investments. And I think that's what we're seeing. We saw kind of a slowdown in the fourth quarter with deals carrying over into the first quarter, just because there was another layer of diligence we hadn't seen previously.
And do you think with the public markets, quote, on sale, that there's a better propensity to go stock picking there versus going private, or are those two different pools of capital we're talking about?
Well, I think one of the attractive pieces for private companies is there's so much dedicated capital to privates themselves, which we didn't have, 4 or 5 years ago. So I think you're talking about kind of two separate pools of opportunity. I think there will clearly be people focused on the public markets looking to evaluate their portfolio and double down in those picks that they're most, convicted with. And I think on the private side, what's encouraging is there's no lack of capital, but they're going to be a lot more selective in how they allocate it.
Yeah, so maybe Eric, I was going to hand that over to you if you want to just piggyback, but go for it.
No, we're seeing the same thing that Brian's highlighting is this, the capital moving downstream into that private market, and the quote search for alpha, right, is going earlier and earlier, so that those crossover funds that were doing these large, rounds and then pushing them IPO just through the financing, syndicate there. Haven't necessarily seen that play out, especially in this downturn of the IPO or the post IPO market. But now they're trying to go into that Series B of the pre crossover round, and even potentially Series A. So for us, it does deal competition, around that, but also thinking through syndicate partners that can help, tell that and carry it forward multiple rounds, to a potential IPO. But it's certainly that search for alpha. And then in our world too, you've got the $1 billion VC funds, and then the more kind of micro, smaller, more focused, targeted, venture funds out there too, that are trying to do things very capital efficient versus the $100 million Series A, type of round. So I think we'll see more divergence there as those two kind of schools develop.
So you think there'll be bigger rounds, but also smaller rounds, depending on the nature of the investor who's leading? Is that?
Yeah, I think we're going to see the same rationalization, in that earlier stage for these companies. That 100 million up front, is a lot of money, but the scale of this biotechs at these stages just aren't there either, right? So that just drives up prices, and I just think there's going to be some rationalization there. And we've certainly, looked at those that have raised 100 million in the last 4 or 5 years that ultimately got IPO, and where are they sitting at a market cap today, and that appreciation. And it's with the exception of one that had venture like returns, it's kind of modest or got your capital back or 1 or 2x type of return over a long period of time. So I just think the rationalization of more efficient capital to hit milestones and keep funding it based on that way is where we'll go.
Yeah, a big Series A requires a large public market valuation to justify, and if those are harder to come by, you might force the more capital efficient models on people. Maybe is how you're thinking about it. That's
certainly our belief in school of thought here at Medical.
One more follow up on you, and then I'll go back to the strategic side. So, is the slowdown on the crossover side, which has been happening because of the public market side, it doesn't seem like, at least in the data, that's had too much of an impact on the Series A and the much earlier stage companies, and that people are going earlier to avoid having such a tie to the public markets. When or how do you think that will start to trickle into the Series A world?
Yeah, I think, hard to project the exact timing, but that's kind of that same rationalization that's kind of working its way through, now. And as part of our fund, both doing company creation, Series A, we are looking at those Series B or pre-crossover rounds just to think through a portfolio construction. And the fundamentals are still there. These are breakthrough discovery, scientific, potentially curative platforms that, if validated from preclinical to clinical, can justify an IPO even in a rational, public markets. Despite the early stage, it's just a real breakthrough fundamental there. So for us, it's just being really thoughtful, due diligent, and kind of a high bar for the story that we're investing in.
Yeah, I'm sure that's music to Liz. Go for it, Brian.
Yeah, no, I would just add to that, in Q3 versus Q4, there was almost a doubling in the amount of Series A's that were closed. And as we think about the crossover world, what we've seen anyway is companies that thought they inherently had a crossover list in place or an investor list in place have been asked to kind of think about broadening out that list to really support an IPO with insider demand. So I think there is a shift taking place. I do agree with Eric. We've seen capital move earlier and earlier. So public funds have now kind of moved into crossovers and even Series Bs to some degree. It'll be interesting to see if that trend kind of reverts back over the coming months based on public market performance, but it's something to keep an eye on for sure.
Absolutely. So makes sense. And I guess maybe Liz, piggybacking off of what Brian and Eric said, it's probably music to your ears if I had to guess that investors are focused on novel breakthrough innovation that could truly move the needle versus incremental. So I guess the question for you, in light of valuations, in light of candidly some amazing innovation, even in the last 6-12 months, and of course before that, is the bar any different at Merck or if any of your peers? Has the innovation bar gone up, or is it business as usual? Or how do you think about when you're sifting through the world of preclinical through proof of concept deals, or maybe on behalf of your colleagues, the later stage, what is their calibration around what is transactable versus before?
So I'd say the bar is the same as recent reviews. I remember back years ago, there's a lot more kind of Me Too, kind of best in class type thinking. But the recent years, and that's no different than this year, is that it needs to be more innovative, new, differentiated. How is it really going to affect patients, and is it transformational? So it definitely moved that way some years ago, and it continues to be that. So there is a high bar on that, being first, being new, being innovative, and really solving an unmet medical need is exactly what we're looking, and most companies are looking for. And yeah, really glad to hear that that's where the investments are going.
So I guess on that, and then get over to Andy on this as well. It's something that innovation is harder and harder as the lower hanging fruit continually gets picked. I think the counterbalance to that is when you have new modalities, new technologies that unlock new areas. That's the argument why people say this time it's different versus biology is biology and attrition rates are attrition rates. How do you think about more innovation being required to get a deal done? At the same time, that makes it harder because low-hanging fruit's been picked, but we have all these new technologies. So where do we shake out from probability of success, which obviously impacts valuations, returns, and everything else? Liz, you want to start that? Then I'll kick it over to Andy.
Yeah, I think, especially on the modality agnostic piece, right? That you think about, we're open to new modalities, but that also means what is the manufacturing? What do we have to build here? And so we look more and more as we're looking at new innovative technologies that need new manufacturing processes. We're already asking very early, what is your plan for that? Because it is going to be a large investment. And there are companies out there that are trying to solve that problem so that there can be more innovation. So trying to solve the manufacturing problem for the ecosystem so that if you can develop the next new modality, then it makes it easier. It's less of a stumbling block to kind of get there, and you can take the risk more and more. So the modality agnostic is interesting, and I think we're in a time where there's just so much new technology and information out there. So you can see that the next 5 years, 10 years is really going to hopefully be transformational for patients. And it's trying to find the path from everything of what we know, what we don't know, and then all the way through clinical development, manufacturing. What is the plan to get there? And so, it's definitely it's a hard problem, but I think working together as an ecosystem. I always say that every piece of the life sciences ecosystem is important. Academia is important, VCs are important, biotech's important, pharma is important, our CROs, our CMOs that we work with. We all need to work together because if one group is lacking, then we're all going to not get there. So I think it's an exciting time.
What I thought was really interesting about what Liz said is that fundamentally, if you're on the sell side, is it's coming down to differentiation, right? How is it that what you're doing is different from what other people are doing? And I think that a mistake that a lot of companies think of is they think of differentiation only within their tiny little bit of what they're looking at. And there's been tremendous advancements in precision medicine where you're not just looking at the totality of a particular indication, but this particular subtype of that disease, whether in oncology or autoimmune disease or whatever. And you have all these IO targets and all these other approaches that people are taking, and people get so caught up in that small little slice that they're focusing in that they sometimes actually forget that Merck, as for example, is not thinking about that tiny little bit. They're thinking about the patients who's actually going to get treated. And if you're thinking about a physician doesn't care whether you have the best version of a particular IO target. They want to know what's the best product that's going to cure my patients. And I think that as we're thinking about differentiation and we're thinking about competition, people have to remember that even though precise is good, you also have to think that competition is at an indication level, at a patient level. And it's how you have to stand out in order to make the kind of noise you need to rise above everybody else we know right now is looking for deals.
So just to summarize this little mini topic, it sounds like the more innovative, the better. Likely that Eric will invest in you, or Liz will license or buy you, and ultimately those that are more me too or less differentiated will have a harder time getting partners and finance. Maybe that's motherhood and apple pie. It's always been the case, but maybe even more so now in the face of lots of other headwinds where pharma candidly can be choosier and investors can be choosier when it's a more difficult market environment. Is that a fair summary?
Yeah, it's a fair summary. And I would say when Andy was mentioning kind of small oncology indications, right? I think, people have been very focused on kind of what target are you going after and what's the competition, but really thinking about the patient, right? If we're talking about multiple myeloma, if we're talking about renal cell carcinoma, what options does that patient have generally over the next 5 to 10 years that it either is there or coming in the clinic, and really being aware as a small biotech what your idea, your hypothesis, your biology may be different and differentiating over what's coming for that patient population.
Maybe an interesting question that I don't know how to solve, so I'm curious to get your all perspective. That, in my view, investors need to be right, call it 3 to 5 years from now, and that they're making a bet that in 3 years' time, we're going to skate to where the puck is going, and that's what the markets are going to want to have to get public. And at that point, that's what pharma is going to want to license or buy. I guess the question for Eric and Andy, and by association Liz, maybe Brian as well, is how do you think about something that's so innovative that it's not yet on everyone's radar, where you can go out on a limb thinking that a pharma company will eventually want to buy that? How do you know that's where they're going to be? And candidly, how do you know that you can even get an early platform deal if these companies, the bigger ones, typically some of them are more risk averse than others? And it's how early do you have to be? How right do you have to be in advance? And how do you not go too far out on a limb where you're too far ahead of the innovation curve, where you're not too late, where there's already 5 companies there and you're the 6th and you're going to lose because you didn't get there fast enough?
So I have 2 answers, and then I know Eric probably has a view on this. I would say first and foremost, right? No, something's not ever too early. From the perspective of early partnering, I suggest for new entrepreneurs, new startups that have these new ideas, to talk to as many folks as they can. Talk to every pharma company out there. I'm Merck, and I'm saying, yep, go talk to other pharma company. Get advice. Start getting a feel of, does this ring true? Does this seem like to be meeting a need? Because you don't just talk to, you don't have to just talk to pharma company, especially BD people, right? With a fully baked, ready to go asset. You could start that early discussion. Am I on the right track? Getting that advice. So I said that was, on one side. On the other side too, we are willing to partner early, but when we are willing to partner early, we're bringing, it's the cases where Merck can bring something to the table that will help the early startup get there faster. And there's recognition that there's kind of doing it together is better than doing it apart. Then I think, if all else works with financials and everything else, I think any pharma company would probably be willing to go early and help take with that risk, depending on the topic and the fit with their strategy.
Yeah, it's well said. No, and for us too, if we'll only invest maybe 5 or 6 companies in a year, right? But we'll see hundreds and hundreds of deals. And so the reality is, we still want to help, even though it's not fit for us, getting it connected or share thoughts and help, think through that. So really echo Liz, your comment around just, getting out there and having been on the operating side too, it does refine your story and your pitch and in your, thesis a bit too, when you are out there incorporating that. For us, getting Jeff to your question too around the science, just thinking differently a little bit. The medicine is just so structured around anatomical disease therapeutic areas, and I know for one of our early investments too, thinking about metabolic reprogramming as a process to disease versus targeting different gene mutations that might be 80 different one of them for a therapeutic area, but yet is there an underlying universal process that we can really affect, and thinking big that way, again, not necessarily the modality specific, but just thinking about disease approaches or treating disease differently. That's just one example. Those are the types of breakthrough ones where what we try to do too is the conversations with Liz early on, or what are those early experiments that would be helpful validating points and incorporating their insight and thinking in terms of drug development and even experimental design, so that when we do fund it or even co-invest in it together, we know what we're looking for, and that answers a key question to our partners, our potential buyers. And so just try and incorporate that input as early, even to the experimental level, when we're thinking about these broad platform, big science type of ideas.
So maybe I can just, Brian, have you tag on to that? If a company is going into a crossover and eventually wants to go into the public markets and doesn't have a partnership, which we actually have some data to suggest that companies that do have a partnership perform better in the after markets, not necessarily because they're better, but because they have some form of validation, probably from someone who's done a lot of homework. How do you think about companies that are not partnered going into a crossover and IPO in a novel area of biology, and the risks those investors are taking, not knowing if someone like Liz is interested or not? Is that, we think that'll change, or how do you think about that risk profile?
Well, I think if anything, the market that we're in right now, they're going to be looking for more of that, not less. We've seen it where the whole concept of a crossover is essentially to kind of pre-sell your IPO, right? To get the right people around the table who will support you in the public markets. And to the extent, and you and I were on a call with a company yesterday, they will benefit in a material way if there is a partnering deal announced ahead of something like that. It serves as a catalyst. I think investors want to see momentum. They want to see the fact that the company is being creative in sort of the steps they're taking to unlock as much value as possible, before, during, and after the crossover, but really leading up to being a publicly traded company. So I think those companies, and we've done the analysis, the step function from a crossover to an IPO with a deal like that, or a really broad list of investors, it's reflected in how it trades and how successful the IPO is. So there is a correlation between the two, and I think more companies should be thinking along those lines.
So Andy, if you want to jump in there, I think it'd also be helpful to get your views on different, you said creativity around this. How companies, could they be creative in the pre-IPO partnering transaction?
Yeah, no, absolutely. And I think what it fundamentally comes down to, when we're in an environment like we're in right now, where it's also unknown exactly how long it's going to last, but we know that it's not going to last forever, is you have to approach deal making with an eye towards the future and what sort of the long-term goals are for the company. Eric talked about the business model and how does that ultimately going to fit. And if you're not really thinking 3 to 5 years out as you're heading into at least, especially a partnership, what you may find is that you have aspects of a transaction that in retrospect are going to cause more harm than benefit. And the deal is important to do now, is important to get that up front, was important to make sure that you're getting some of that additional validation for financing. But you have to weigh that against what happens 3-5 years from now when you have other things that you've been working on. There's other aspects to the pipeline, et cetera. And so when I think about creativity in deal structuring, I think, there was if you're a platform company, it's the 5-target deal is the lead that's already been announced, and it's a co-pro co-dev that goes along with it in terms of the option. And, that's sort of what investors wanted to see. And it's not that that's necessarily going to change, but it's also true that, realistically, how many of those companies with a depressed stock price are ever going to execute an option on a co-pro co-dev? And so what does that do to their perceived value in their lead program? And so it may lead to a situation where you have to keep more of your lead. Maybe you do that co-pro co-dev on the second asset if it's close enough, or you have to really think through other mechanisms that still work for big pharma, given that, they want the best things that they can get their hands on, because why wouldn't you? And at the same time, preserve enough for yourself that on the back end, once you're back into a more friendly environment for capital raising or additional BD deals or anything else, the deals that you did right now aren't going to accidentally hamstring you. The specifics of it's going to be driven by the particular company. So it's hard to say exactly what that's going to be, but it's going to be around governance. It's going to be around IP in the platform, and it's going to be opt-in, opt-out rights on various aspects of what you're doing.
Well said. And maybe just since we're talking so much about the environment and we're assuming that it's, gloom and doom, and maybe it's worth focusing on that for a second. Brian, I'm going to push this one back to you. It was a question in the chat, but also something we had before about interest rates and inflation and the impact that those two things are having on biotech. And I know you're not a economist at the Federal Reserve, but how do you see interest rates and inflation impacting the biotech market? Because that could have implications on partnering, public, private fundraising, as well as the duration of the impact.
Yeah, I mean, I think there's kind of two sides to the equation. Most biotechs are pre-revenue with their value based on future predictions. So future dollar weakens due to inflation. It's going to have an impact on present day values. The flip side of that is most of these development stage companies don't use debt to fund their operations. So if we look at the reaction of the market suggesting we are going to see rate increases, I think there's less sensitivity. The amount of innovation we're seeing on the science side, I think will sort of lead the day. I think valuations will be impacted by rates and by people's kind of general overall perception. And so I think investors will be looking for better value. But generally speaking, I think, as it relates to the early stage companies that we deal with, it won't have a material impact.
I mean, it's come up a few times just in terms of the vendor contracts and clinical trial costs, and just everything going up. In terms
How about
of
salaries?
Well, and that's where I was going to go is actually, I think the bigger challenge is just the labor markets. It's such a tight competitive market, to get top talent. That's where the more pressure is and price increases, but yet you want great talent, and great talent should be rewarded too. So I just think it's it is part of our conversation as we're thinking about budgets for, the next 12 months, 18 months, 24 months, thinking about making sure that we have those price increases and we are really adjusting for the new labor market as there's a fight for talent.
Yeah, I think everyone's seeing that. So many conversations with clients that they can't get teams, they can't hire fast enough. People are hiring folks in different geographies, not necessarily in their home base to accommodate, and salaries are accelerating. And I imagine that will put a constraint on some of the capital efficiency that I think you and others would be hoping for. So maybe just trying to, as we get towards the end of the hour, thinking about hopefully something more positive. I'd love to get your outlook for the potential for a bounce, or I'll call it a recovery, because I think at this point it's certainly, we're in bear market territory, at least in the stock market, and certainly recently in the deal world, especially on the financing side. But when do you all think that this will come out? Because this too shall pass. It always does, but the question is how long. So maybe go around the horn and get your views on crystal ball when we can have expectation of better times. So maybe Andy, if you want to start this one.
Sure. So I think that usually there's a cyclicality to this, as I think we're really hearing from us. When capital markets are up really high, the deal making tends to go down. And so if the capital markets are going down, deal making is going to start going up. And given the level of conversations I know that we've been having, others have been having, likely I imagine over the first quarter into the second quarter, there's going to be a lot more deals that are getting announced that have conversations that got started in the fourth quarter of last year. And I think as we see a lot of these deals start to work their way through and people are seeing that there's still investment into good science, is an investment by a strategic as opposed to an investment by an investor, there's going to be probably, and Eric could probably speak to this better, a return of confidence in knowing that if I'm funding companies, there's still a path to exit and that there's a way to find returns on those dollars that are coming in. And so I think that the recovery is going to be led through the deal side. If we start seeing M&As, if we start seeing higher value licenses, as data readouts are coming, people are still getting paid out for quality phase 1, phase 2 data. That's where I think it's probably going to start working through the risk. I guess that channels it more towards, mid-year, maybe into the third quarter. Hopefully we'll start to see a bit of a turnaround. But I think investors are going to be looking at the macroeconomy, and they're also going to be looking to see if the industry is remaining active. They'll get a little bit happier.
Next, go for it, Eric.
I'll piggyback too, but I'm no economist and projecting future geopolitical events. But to me, that there's nothing structurally that's changed compared to the 08 crash and even the tech right in the 90s. There's just nothing that's fundamentally structurally changed other than this rationalization of a lot of capital came in, right, and prices went sky high over a 3-4 month period as the vaccine was coming to market and COVID has hit. But as things settle a little bit, to me, it's I'm as bullish as ever on the opportunity over, particularly in our timelines, 8 to 10 year fund cycles for the M&A environment. Pharma still has products coming off patents. There's pressure around the exclusivity protection there as they come off patent. And so again, trying to then help them, they are going to have to acquire, they are going to have to bring, new platforms and products in-house. And I think the universe of new big pharma coming out is also, emerging. So for us, thinking through the 3-5 long-term horizon, I think it's actually quite bullish given the advances on the science side too. You look in the publication domain. I saw one of the questions in there: how do you get comfortable around new biology? It's kind of, where is it coming from? Who are the grants? Who are the labs? That have supported it to date, and finding that breakthrough kind of validating point in the academic world is one big area that we help find. So I know, back to your question just around timelines, I think this will be a sift through in the next, call it 12, 18 months as things kind of settle in. But, M&A does start picking up. And I think over the next 3 to 5 years, it'll be pretty good.
But I guess just before passing it off to Brian and Liz, as a newer fund, this wouldn't be bad for your vintage if you start investing in a down cycle.
Well, I joined Domain back in 08, right after the crash. So, it does. I think if you've got the capital, this is a really exciting time to start putting it to work, because the fundamentals of the ecosystem for venture-like returns still is there.
Yeah, it just took 4 or 5 years to get out of the 08 doldrums. So that's my only hesitation with
that was a structural fundamental thing that I think got fixed over a period of time. I haven't seen that structural issue here with this kind of pullback.
That's fair. Brian, do you want to go next?
Sure. I mean, I think, as I said earlier, we saw a tremendous run the last couple of years. Last year was a bit of a correction for a whole host of reasons. I think what we'll see is a sorting through of investments in the first half of this year. I think there's so much money on the sidelines that people are going to look for good value and for opportunities. And the innovation that we've seen, the companies that we're talking to that are looking to work with us in various different ways, it's the best I've seen it in doing this in 30 years. So I think with that as the backdrop, always going back to the quality of the science, I think we will see a pickup in the back half of this year with people looking for better valuations, and probably taking likely a bit longer to diligence things.
So Brian, just one more quick follow-up on that before passing it off to Liz. Do companies understand this? Because I know boards really figured this out yet, that they're going to rationalize their expectations, or is it going to take time for them to realize that it is a little bit different now from a value perspective?
I think it's going to take some time. I also think it's going to take some real feedback. You know, I urge companies all the time that are looking to raise capital, whether they work with us or not, to be in market having conversations, build those investor relationships, do it over an extended period of time. You're looking to finance your company over multiple years. And I think those lead to good discussions and helpful outcomes for companies. So I think the opportunities here from a valuation standpoint, generalists, when a sector is hot, generalists pile into it. I think we've seen a lot of that washing out take place the last quarter plus. And so I think what we get back to is sort of traditional biotech investing, looking for value, focused on the science. And I think there'll be opportunities this year to get a fair amount done.
Cool. Liz, I'll let you take us home with your concluding thoughts on where you see the year going, where do we get out of it, and anything uplifting you could conclude us on.
Yeah, so I completely agree with Andy's statement about the typical cyclical nature of capital markets and partnering. And I've already warned my team 2022 is going to be extremely busy because that partnering is on the upswing right now, and I do see a lot of deals over 2022.
Cool. Well, even though we're a minute or two early, it's probably not enough time to dive into another whole topic. So I think we'll put a bookmark here. I really appreciate the four of you joining, as well as everyone in attendance. As a reminder, a link to the recording will be sent via email to each registrant. You can also visit the Locust Walk website to download the year-end market conditions report. So thank you all. Look forward to seeing you in person, hopefully soon.
Thank you.